Everyone says the Magnificent Seven or can't miss. But here's the truth. The price you pay determines the story you live. Today I'm ranking all 7 from worst to best, based on long-run return potential, and I'll show you the buy-zone framework I use so you're never overpaying for a great story again. In 2000, Cisco was the first trillion-dollar company in waiting. Revenues 4.5 times since then, profits 5 times, yet the stock never reclaimed its dot-com peak for decades. Why? Valuation. People paid any price for a perfect story, and the math never caught up. That's our compass today. Every investment is the present value of future cash flows. Narratives help, but the numbers decide. Let's start with Tesla, the company I rank at the bottom in terms of expected long-run return potential. Now, don't get me wrong. I respect Tesla as a business and admire the products they've built. I even have a lot of respect for Elon Musk's ambition. But when you strip away the narrative and look at the numbers, Tesla is still, at its core, an auto company. Roughly 90% of its revenue today comes from car sales. Yes, there's optionality in things like energy storage, robotics, and full self-driving software, but the market often values Tesla as if these future opportunities are already mature, cash-gushing segments. That's dangerous for investors because optionality is only valuable if it eventually turns into consistent free cash flow. When I apply my buy-zone rubric, I treat Tesla as a hardware company with some software potential. That means I'd want to own it at 12 to 14 times normalized free cash flow unless the software mix becomes both meaningful and proven. At today's valuations, Tesla trades closer to a pure software multiple without actually earning software-level margins. Until the numbers align with the story, it stays on the overpriced side of my spectrum. At number 5 is Microsoft, one of the greatest compounders of the last 2 decades. With Windows, Office, Azure, and now AI copilots, Microsoft has proven time and again that it can adapt and extend its moat. I've made the mistake in the past of selling Microsoft too early simply because I thought it was slightly overvalued. That experience taught me a hard but valuable lesson. Let your winners run, but enter them at the right price. In Microsoft's case, the right price for me is around 18 to 20 times normalized free cash flow. For a company with its track record and durability, I'll stretch to 22 times if I see clear evidence that mid-teens growth can sustain with healthy operating leverage. Microsoft is a textbook example of an A-tier tech business, but even with the best names, discipline matters. Coming in at number 4 is Apple, the cash machine that continues to defy skeptics. Apple generates staggering amounts of free cash flow, averaging around $100 billion a year over the last 5 years. What makes Apple particularly fascinating is its shift toward services, subscriptions, app store fees, and other recurring revenue streams that carry higher margins than hardware. This services mix is steadily boosting Apple's profitability, giving it the characteristics of both a hardware and a software business. Because of that, my buy zone for Apple is similar to Microsoft's. I want to see it in the range of 18 to 20 times normalized free cash flow, stretching up to 22 times if the services revenue continues to scale and demonstrate stickiness. Apple is a business I'd never bet against, but I still refuse to prepay too far into the future just because of its brand power. In third place is Nvidia, the company that has become synonymous with the AI boom. Nvidia has executed brilliantly, capturing dominant market share in GPUs that are essential for AI training and inference. Its balance sheet is strong, its cash flow has exploded, and its technology leadership is undeniable. But here's the catch. Markets have a way of overpricing perfection. In Nvidia's case, valuations have surged as if its recent, record-breaking growth will continue indefinitely. That's rarely how cycles play out. For Nvidia, I apply the same A-tier buy-zone framework, but with an important caveat. I never apply my multiples to peak free cash flow. Instead, I normalize it across several years. That puts my buy range closer to 18 to 20 times normalized free cash flow, not the inflated numbers from peak AI hype. If you buy Nvidia only on the best possible year, you risk paying for growth that can't repeat. Second on the list is Alphabet, the quiet compounder that still has plenty of levers to pull. Between search, YouTube, maps, and cloud, Google is deeply embedded in the lives of billions of people. It throws off cash, maintains strong margins, and has more resilience than most investors give it credit for. The real underappreciated drivers here are YouTube monetization and cloud profitability, both of which could meaningfully boost cash flow over time. Alphabet fits squarely in my platform, ad hybrid category. I'd like to own it around 16 to 18 times normalized free cash flow, with some willingness to stretch toward 20 times if cloud continues its profitability trajectory. Historically, Google has been one of the best buys when sentiment turns negative and the stock dips below its fair multiple. That's when patient investors can take advantage. Finally, at the top of my ranking is Meta. This is a company I was buying when it was hated, around $88 a share in late 2022, and it's since rebounded in spectacular fashion. The core thesis for Meta is simple but powerful. It controls the world's largest ad platforms through Facebook, Instagram, and WhatsApp, and yet its international monetization is still just scratching the surface. While US users generate over $40 in ad revenue per year, international users only bring in a fraction of that. As global incomes rise, Meta's monetization gap should steadily close. Meta falls into the same buy-zone category as Alphabet, 16 to 18 times normalized free cash flow, stretching to 20 times if engagement and margin trends remain strong. The combination of scale, optionality, and under-monetized assets makes Meta one of the best-positioned Magnificent Seven members for long-term returns, provided you enter at the right valuation. As you can see, every single one of the Magnificent Seven is a world-class company. The ranking isn't about which is good or bad, it's about which offers the most reasonable path to long-term returns when purchased within its evergreen buy zone. Tesla, for example, might have extraordinary optionality, but at today's multiples it doesn't provide enough safety. Meanwhile, Meta and Alphabet, with their underappreciated levers and healthier valuations, offer clearer paths to compounding wealth. The lesson is simple. Even the greatest companies can be bad investments if you overpay. Stories may shift, technology may advance, but valuation discipline never goes out of style. That's what separates a hype chaser from a true investor. To make this framework evergreen, I don't anchor to today's prices or headlines. Instead, I focus on a timeless valuation rubric that works across cycles. For A-tier technology companies, the ones with durable moats and recurring cash flows, I look to buy at no more than 18 to 20 times normalized free cash flow. If I'm using owner earnings as my yardstick, I'll accept 20 to 22 times, but only when I also see a clear path to at least a 10% long-term return on invested capital after tax. For platform, advertising, or cloud hybrid businesses, the multiples get a bit tighter. I'll consider buying at 16 to 18 times normalized free cash flow if the company is showing mid-teens top-line growth. I might stretch that to 20 times, but only when there's clear evidence of operating leverage. That is, proof that revenue growth is actually dropping to the bottom line in a sustainable way. When it comes to hardware or auto companies with optionality, the kinds of businesses that make most of their money from physical products but also dangle future software or service potential, I get even more conservative. My buy zone is usually 12 to 14 times normalized free cash flow unless the software mix is already real and producing meaningful cash, not just promised in presentations. On top of that, I demand at least a 20% discount from fair value as a margin of safety. I call this the rule of 3. I want a credible path to a 10% or better internal rate of return using realistic, not heroic, assumptions, And I need an extra buffer of 15 to 25% margin of safety to protect against surprises. This framework also tells me how to act depending on where a stock sits relative to its zone. If the price is above the buy zone, the stock goes on my hold list or watch list. It may be a great company, but it's not a great investment at that price. If the stock is inside the buy zone, I buy slowly and scale in over time. And if the stock drops below the buy zone while the thesis is still intact, that's when I consider loading up more aggressively. What I call the back up the truck moment, executed responsibly. If this helped you think clearly about price versus value, hit like, subscribe, and share this with the friend who only buys headlines.